Hi, let's talk about the taxation. So when you're investing in a fund and you're earning out of it, then you need to pay tax. And let's find out what kind of a tax that you need to pay. So when it comes to a debt fund or even for equity, there are two classifications. One is a short-term taxation, and one is when you're invested for long-term, and then there is a different taxation for it. So when we talk about debt fund, anything below 3 years is considered as a short term, and anything above 3 years would be considered as a long-term investment. Now when you talk about short term, if you buy any mutual fund and if you sell it before 3 years, whatever you earn on it, that capital gain would be termed as a short-term gain, and on that tax the taxation would be whatever you have earned would be clubbed as your income, and whichever tax slab you fall in, 20%, 30%, it'll be taxed accordingly, right? So short term, below 3 years, whatever you earn gets added to your income and you are taxed as per the slab. Now as far as the long term is concerned, if you spend more than 3 years in an investment, you get the indexation benefit, which is the inflation. Inflation is taken into account, and your tax outgo actually reduces quite a bit. Now let me explain it to you in detail as to how actually it works. So let's say you have invested in a fund and let's say 100 rupees, and after a year the inflation is 107. There was a 7% inflation, right? So this inflation would actually help you reduce your tax outgo, right? There's a cost inflation index that is released by the government, and it's updated on a yearly basis, and this would take into account the inflation. So let's say in 2014 you invested 1 lakh rupees, and in 2018, so you've spent close to 4 years, this sum is now, let's say 1,40,000. So your gain here is 40,000 rupees, right? This is your gain, right? Now in case if there's no indexation benefit, then your tax outgo would be more, but because of the indexation benefit. And how do you calculate this? Let's look for the cost inflation index. Let's look at the cost inflation index. Okay, so this is the cost inflation index. Let's say we bought it in 2014 when the inflation index was 240, right? So let's just write this. Here it was 240, and when we are redeeming it in 2018, let's say this was 1st April 2014 and we are redeeming it on 1st April 2018. So we've spent close to 4 years in the in the fund, and in 2018, the 1st April, it was 272, right? So we have spent 1, 2, 3, 4 years. This was 272, right? Now what we do is we would divide 272. We would divide 272 with the base figure, which is 240 in this case, right? For each case there will be a different one. Now this figure that we get, we would multiply this with our investment. So we are inflating the figure. 1 lakh we had invested, so 1 lakh, the inflated figure after 4 years is this much. So our gain is 1,40,000. This is what the value is right now. The net gain would be, we would not subtract 1 lakh but this figure from it, so our net gain is 26,666, and on this 20% is charged as tax. So here the tax would be, this would be the tax outgo, 5,333. Now in case if this was not the benefit, if we were not taking inflation into account, and if this 40,000 would have been added to your income, the tax outgo would have been far more, because if you would have been in 20%, 30% bracket, let's say if you were in a 30% bracket, 30% would have straight away gone to tax, which is 12,000, but here you're just paying 5,333. So this actually works in your favor quite a bit, right? And how you calculate this is you would take the cost inflation index of the year that you invested the money in. If you spend more than 3 years only, then it makes sense of doing it. And when you're redeeming it, so you would take the cost inflation index, divide the current with the previous one, in this case 272 divided by 240, whatever number that you get, you would multiply this number with your initial investment, so you get the inflated figure, right? That inflated figure is your acquisition cost. So you would now subtract your whatever proceeds that you have received with this figure, and whatever gain that you have made, you have to pay 20% of that gain, right? Which is much lower, right? That reduces your, in case if you would have been paying 12,000, here you're not even paying 50% of that, much lower, right? So this would actually reduce your tax outgo as well. So this is for the debt fund, right? Short term and long term. 3 years, above 3 years is long term, you get indexation benefit. Equity is a bit different. Equity, again, you'll have the same concept, short term and long term. So in short term, what is the short term first? Anything below 1 year is short term, anything above 1 year is long term for equities. Now in case if it's below 1 year, whatever you've earned in your equity investment, there'll be a tax of 15%. It doesn't matter which bracket you belong to, which tax slab you belong to, the straightaway charge would be 15% on your short-term income that you've made. The capital gain that you've made, there'll be a charge of 15%. However, for long-term, there is a different calculation. So if you spend more than 1 year, whatever you gain becomes a long-term capital gain, and there is a charge of 10% only if that gain exceeds 1 lakh, right? So let's say you have invested in a fund, you had invested 1 lakh again, and within a year it became 1,25,000, and you withdraw it before completion of 1 year. So this 25,000 that you have gained would be termed as short-term capital gain, and there's a tax of 15% straight away on it, right? Now same scenario, 1 lakh and it becomes 1,25,000. So there's a gain of 25,000 rupees. Here, since you have spent more than 1 year, it's a long-term capital gain. Now you would be paying a 10% tax only if your long-term capital gain exceeds 1 lakh rupees, right? So if this is the only investment that you have done, you would not be paying any tax on it. If it was, let's say it was 10 lakh and has now become 12 lakh 50,000, your overall gain would now be 2,50,000. So your net tax here would be, you'll subtract 1 lakh from it. This is your long-term capital gain, and on this you'll be paying 10%, right? So short-term capital gain in equity, you're paying 15% on your capital gain. Long-term capital gain in equity, anything above 1 lakh, you're paying 10% return, you 10% tax, right? So that's how it's actually calculated. And for debt, short-term gain in debt, it gets added to your tax bracket as per slab, whatever slab that you're in. And if it's a long-term capital gain, that means you have stayed invested for more than 3 years, then you'll get the indexation benefit. So 20% tax after indexation, right? So this would reduce your tax quite a bit, right? So this is how it's calculated. So these are the charges, and this is few things that you need to keep in mind while you're investing in a fund. So if it's a long term, then you stand to gain as far as taxation is concerned, right? So we have almost come to an end. Now in the next video we'll be looking at the portfolio review, how you can actually do that, and let's dive into it.